Hello, friends. Today we discuss one topic from entrepreneurship development. This is one of the, you can say, very important topic, that is sources of financing. Sources of finance, why very important? This is very important because without money, you can't run the show. Money is the lifeblood of any business. Finance is the lifeblood of business. In finance, we have to study from where we arrange the finance and how we procure and how we use all the funds in the business. As this diagram shows, sources of finance include long-term sources, short-term sources, bank overdraft, leasing, additional capital, retained earning, trade credit, grants, mortgage, you know debt factoring, right? So many methods of finance. But why finance? What are the main objectives of finance? No doubt there are two objectives only. Objective number one is profit maximization, and another one is wealth maximization. But how we procure the fund and how we use the fund, that is very important. So step by step we discuss everything. We need funds for long run as well as short run. For short run, if funds are needed, these funds are known as working capital decision, and when funds are required for long time period, they are known as capital budgeting decision. So here, first of all, we discuss about what is working capital or short-term sources. So we have basically working capital is the capital which is required for day-to-day purposes, or also which is required for to make the operating cycle of the company. So we have two concepts in working capital. One is gross working capital. The working capital is gross working capital is equal to total current assets, right? When we are talking about net working capital, then we have current asset minus current liabilities. Now the question arises, what we includes in current asset and what we includes in current liabilities. Current assets include cash in hand, cash at bank, prepaid expenses, debtors, stock, raw material, marketable securities, debtor, bills receivable. On the other hand, current liabilities include short-term loans, creditors, PP, outstanding expenses, as well as we can say any kind of investment income, or we can say accrued income, all are included in liabilities. So difference between two, we treated it as a net working capital. If you want to estimate the day-to-day working capital requirement, you must understand the meaning of gross and net. Gross means total current asset, net means total current assets minus current liabilities. Components of working capital. Working capital include basically cash include cash in hand, cash at bank in a year. मतलब the cash requirement for a year, or we can say excess of cash balance should not be kept in business, because cash is a non earning asset. If you have a good cash position, means your liquidity position is high but profitability less, because if you invest the same somewhere, so you can earn a lot, right? So proper and we can say proper management of work cash is required. Then we have marketable securities. These securities also don't give much profit to you, because marketable securities act as a substitute of the cash. Whenever you need a cash, you convert it in cash. This is a temporary investment, and such type of investment not give you so much return. Then we have account receivable, or we can say BRs and debtors. This is again a very risky kind of investment, because sometimes more and more cash held in account receivable. Say you gave more credit to debtors, save 3 months, you pay us after 3 months all the sum. That is very risky for you, so you try to avoid this. The length should be lesser one. Inventory represent a substantial amount of firm's assets. Inventory must be properly managed, so that this investment does not become too large, like inventory means your stock of raw material, work in progress, finished good. Okay, you not try to hold more and more cash in inventory. Prepaid expenses represent the service owned to the company, thereby eliminating the need of the cash outlay. Means you pay the expenses in advance. Say you not avail the service of the month November 2020, but you pay the rent for 2000 November 2020. That is prepaid, and that is again very harmful. Now we have operating cycle. What is operating cycle? Operating cycle is a cycle which starts with cash and ends with cash. It starts from cash, right? Then converted into raw material, then cash converted into raw material converted into work in progress converted into finished good converted into debtor. Because when goods produced na, at that time you definitely sell it to debtors, and debtor, if they ask time for 3 months or 2 months for the payment, in that case converted into BR, and then bills receivable ultimately converted into cash. This is all about operating cycle. Every company try to reduce this cycle, because if this cycle is bigger, you required more working capital. If this cycle is minimum, in that case you require less working capital, right? Now a very important term in financing is there are some working capital strategies. These strategies are important to discuss here in working capital. One is aggressive financing strategy. What is aggressive financing strategy? Is one by which a firm finance at least its seasonal requirement, and possibly some of the permanent requirement with short-term funds only, and the balance is financed by long-term funds. I'm telling you this thing. Aggressive financing policy means when you rely more on temporary, we can say short-term sources. There are two types of sources through which we finance working capital. One is long-term sources, and another one is short-term sources. Working capital required for permanent basis, also for seasonal variations, for seasonal reason also. Say your normal sale of normal sale of microwave in a year is say 10,000 per month. Okay, because of some festival or something, if that demand increases a lot, that is known as seasonal demand. So according to the aggressive approach now, the need of the firm rely more on permanent as well as for seasonal requirement, more on short-term sources, and less amount for long-term sources. So this kind of situation is basically known as aggressive financing approach. In this particular approach, they have less liquidity and more profitability. Then we have conservative financing strategy. The most conservative strategy is all the projected funds are financed through long term sources. Means if you required funds for fixed asset, go for long term assets, long term equity capital and preferential capital. If you need funds for permanent level of current asset, even then you rely on equity and preference. If you required money for short term reasons, like for seasonal variations, even then you met with the long term sources. In that case, liquidity is high because you have all the time, you have resources, but profitability is very very less. So both, risk is very less, risk is less, profitability is less, but liquidity is more. Then we have moderate financing strategy. A moderate means matching approach. According to this approach, if you need funds for long term sources, you go for long term requirement. If you have long term requirement in the business, say for 2 year, for 5 year, you need funds, then you go for permanent for a permanent kind of working capital, like long term sources. You rely on long term sources. On the other hand, if you required funds for 1 year, 6 months, 2 months, then you go and get the funds for 2 months, 5 months, or 1 year. Means if you need fund for 10 year, you arrange from 10-year financing. You need fund for 2 months, you arrange from 2 months. In this case, liquidity, profitability, and risk all are balanced. Then we have long-term financing. Long-term financing, we have equity share capital. What is equity share capital? Equity share capital is a capital which is required for long time period, though a company's capital is divided into different small part. Each part has the same value. If suppose I have 10 rupees 1000 share of a company, so my liability toward company is 1000 into 10, that is 10,000 rupees, right? Equity shareholders are the real owner of the company. This type of capital, there is no need in according to the Companies Act 1956, amended Act 2013, and again amended in 2016. No need to refund that money during the lifetime of the company, right? And they get dividend after at the end. Like if company become insolvent, then first of all pay to the outsiders, then to pay to the preference shareholder, then equity share, then equity shareholder. Okay, so but the most speculation and most business is run by such kind of capital. Then we have retained earning. This is also a source of finance. Like if company earns something, say the earning, total earning of the company is 1 crore, right? They first of all they pay first of all they pay to the debenture holder, then they pay some tax, say 60 40 40 lakh is the tax. They deduct that tax, then they have a balance of 60 lakhs. That 60 lakh they distribute to, first of all distributed to preference shareholders. If something is left, then they pay some dividend to the equity shareholder, and they again the balance amount, say 10 lakh, they reinvest in the business. Retained earning means the part of the profit which is reinvested in the business. Such type of financing source not need any cost, because this is free of cost. But what I feel, what is the cost of equity share capital? That is the cost of retained earning.